So now the big question, of course, is what are the underlying trends in this market? And if so, how should we be viewing the movements in the context of both flows and corporate performance present and near future? To discuss this, I reached out to Ajay Bagga, veteran market analyst, and I began by asking him how he was interpreting the events of the trading days in the recent past.
The amounts are quite high. Historically, you would not get such high levels. Nearly 3 lakh crores have gone out from the secondary markets over the last 1 year, and it has accelerated in January and February. I think that's one reason the absolute amounts are big. The second reason is that there is some slowdown in the retail sentiment. So, probably the direct retail buying is not happening as strongly, even though mutual funds have been buying and they have absorbed most of the selling by the FIIs. And third is the impact cost is high. So in February, Govind, we saw mid and small cap indices fall by 11%, while the Nifty and BSE Sensex were down more than 5.8% each. So that 11% is more the impact cost. So that is coming through. Wherever there is selling in small and mid caps, we are seeing some amount of damage coming in much faster. So those two are already in a bear market at 20% plus from their all-time highs, while the Nifty and Sensex are fighting to stay above 20% falls. They are at about 16% right now.
Right. And if you were to correlate this equation, and when I say equation, I mean between foreign and domestic flows historically, are there any periods that stand out either because of the way it's similar or dissimilar?
Whenever we had foreign outflows, like in 2000, 2008, 2013, at the time of the taper tantrum, and then the Trump tariff one, 2018-19, when China did a big devaluation of its currency, when we saw foreign investors going out in the pre-COVID period, Govind, we would have much more damage to the Indian markets. This time around, it has been more muted because the domestic flows have become very chunky, very large in comparison to the incremental foreign flows. Foreigners still are about $850 billion in a 4.2, $4.3 trillion market. So they are 18, 17%. But the DIIs plus the Indian retail plus insurance has now caught up with the FI, at least on a portfolio basis. Incremental flows, we are just about matching. We need more to come in. But what happens on a 1 year basis now, we have given up the returns on the leading indices. So Nifty and Sensex are mostly flat on a 1 year basis, while small cap, mid caps, where a large portion of the retail money was going, are negative on a 1 year basis. Then damage starts happening to retail sentiment, and you could see more SIPs getting stopped out rather than being formed. So that is the risk we are running right now. But historically, if we see, we have seen big portions of FI outflows, and the markets used to be hurt much more. Not so much this time because of the domestic cohort coming in.
How would you classify foreign portfolio investment in its smartness? And I'm drawing a distinction between the sort of amount or quantum of money flowing out versus, let's say, the strategic nature of that sell decision. As in, are they selling or have they been selling because they're not seeing value in certain sectors specifically and therefore are taking very well researched calls? Or is it like a general exodus?
It will be both because it's not a homogeneous segment. There are sovereign funds who come in for 20, 30 years. There are pension funds who again come in for long periods, universities. These are the three big chunky players who invest into India. These are all long-term players. Then you have the hedge funds, the long shorts, who might have a smaller window. Secondly, if it's a GEM fund, a global emerging market fund, and they have outflows based on, say, Thailand or Philippines or Indonesia or China for most of last year, they would have had to take money out of India as well. Then you come to India specific country funds, where again, because the dollar returns were not that good over the last 1 year, we have seen some amount of sentiment breaking. The big elephant in the room, Govind, was US money market funds giving you 4.5 to 4.8% on a risk-free basis in a dollar asset sitting in the US. And if your Nifty on a dollar sense was giving 4% returns after all the churning, all the volatility you had to face, and then you have to pay taxes on taking it out, that really spoiled the sentiment. So it was a function of valuations, it was a function of slowing down of the economy. The FIIs seeing that corporate earnings were slowing down over the last 3 quarters, government expenditure fell, tightening liquidity because RBI was defending the rupee and selling dollars into the market, absorbing rupees. Liquidity tightened systemically. And based on that, we also saw the rupee falling. All these combined into a perfect storm. And we saw on the margin foreign money going out. Again, if you see, we started at about 900 billion and about 20-25 billion would have gone out secondary markets. Primary markets, we still attracted funds. We are getting funds from the PE VC segment, even though they made good amounts in the IPOs that they exited out. 2 lakh crores was sold out by the PE VCs and in QIPs last year. All that hit the secondary market liquidity. So it became a perfect storm of an asset which was very highly valued and not giving that much returns. And on the margin, money started flowing out.
Right. You touched upon tax, Ajay. So there have been a few other voices in the markets which talked about this today, specifically tax on foreign portfolio investors, and of course, in general, long term capital gains tax on Indian investors, particularly long term. So now, obviously, this was not so much of an issue or perceived as an issue. And is that because maybe the markets were doing well, so therefore people didn't focus so much on it, but now people are feeling the pain?
From the last budget itself, it was a pain point for foreign investors because if you don't have an offset in the home country, your all these funds get domiciled in such a way that they are coming from tax havens. Even if they are American funds, they will come as Delaware or Cayman Island funds. Singapore will come under the treaty. Mauritius, of course, was the traditional treaty. Japanese funds would normally come from Cayman or Luxembourg. So there were treaty protections for all of them. That has slowly got eroded. Now we have reached a point where they are paying substantial taxes. And you are right. If you are seeing growth and earnings are growing 17-18%, you can catch a company growing 25%, make 20% on your entire portfolio. You don't mind paying 2-3% tax and 2-3% of rupee depreciation. If you're making 12-14% overall returns when you take your money out. But if you're making 4%, $4.50 returns after all this heavy work, and then you have to pay tax which you can't claim back, then it becomes a no show. So, again, sovereigns or universities or pensions will not take decisions based on tax. They will take a structural view of India, but it does rankle the hedge funds. So, they would try to find ways of having synthetic exposures, or they will take exposures offshore in the GDR market or something like that, where they don't end up paying taxes. But then that makes it a very shallow market. So let's see what comes out. The government hopefully will not get stuck to its position and will look at it because we are a capital deficient country. We need huge amount of capital for the infrastructure build out that has to happen over the next 20 years. We need trillions of dollars to flow into this country. So we should welcome that foreign capital. It should not be an East India Company kind of outlook, which the communists would always do. We should rather embrace that capital. And if it's really coming from pensions, sovereigns, and from universities and large funds, I think we should make that capital feel welcome in India.
How are things looking in the next few months? I mean, just from a mood and maybe if there is any cyclical trend or cycle that you're seeing within the way markets have been moving.
See, the big move will be twofold. One, the Trump tariff and Trump uncertainty has to move out. I think over the next 3 months, that will get resolved. The second part, will be Indian earnings recovery. And already we saw with this GDP for the December quarter, it's a big jump. And even the last 2 years GDPs have been, revised upwards. So that's giving hope. If you look at the capex expenditure of Government of India, December saw a 91% year-on-year growth. They are in a catch-up mode. January saw 51% growth year on year. So what got missed out because of the elections and the intense heat and the budget finally coming through July, orders coming through October and money getting dispersed in December, that's coming through. But these 4 months are too short to catch up. So we won't meet the 10 lakh crore expenditure on capex, but we will do 9 lakh, 9 lakh 50 or something, which is good enough. It sets the ball rolling for April. So overall, I think with the base effect, corporate earnings start looking up by June. By September, you will see the economy rolling much faster if the Trump issues get resolved. I am not expecting much disruption for India. There will be opportunities for India. Even we have, if you look at rare earths, for example, we have 8% of global reserves and which we have not been able to so far utilize. If we can do an agreement with US, welcome their miners to come in and start extracting those rare earths. All those kind of opportunities are there, but structurally, I think September is when you start seeing very good earnings and feel good factor coming in. And then October with the festive season and Diwali, I think you could see a pickup coming. So markets will react in advance, Govin. I would say May, June, probably you will start seeing Indian markets going up again.
Ajay, it's been a pleasure. Thank you so much for joining me.
My pleasure. Thanks for calling me.